G'day folks and welcome to the Property Couch, and yes, it's a different voice this week. That's right, Bryce is away, so I am going to play as the only host for this podcast this week. And in this week's show, we're going to focus in on investment savvy mortgage brokers. We're going to unpack a couple of great case studies that allows you to get an inside view of what happens when a broker solves customers' problems. Furthermore, in What's Making Property News, there's another tax increase happening in New South Wales, so I'll tell you all about that later in the show. So let's rip into the show, as Bryce would say.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
Yes, that's right, people. You've just got me today. No, Bryce and his beautiful wife, Andrea, and their boys, Jack and Samuel, are on their way on their European adventure. So it's going to be exciting for them as they spend a bit of time over there, taking advantage of the fact that the boys are in primary school. So taking a few weeks off. Bryce will be back, however. Let's make sure this is episode 499. So we do know that Bryce will be back next week as a special pre-recorded episode for our 500th. And we've also got a huge guest also for 501 as well. So we'll hear Bryce in those particular episodes. So without Bryce, I'm just going to rip into the show. And I obviously also get to talk footy, because did we see Collingwood come back from 54 points? I mean, it's the second highest, sort of deficit to actually come back and win a game in the history of the game. It was incredible. Obviously disappointing for North Melbourne, but Bryce can't shut me down on talking about footy. He's probably having a little smirk listening to this somewhere in Italy at the moment right now. Anyway, that's enough footy banter. Let's get into some quick housekeeping. So there's a few important things that I just want to remind everyone about. Firstly, we had the Picker webinar, in terms of small developments. So that will now be on demand. So wait for that to come through. You obviously need to be a Picker member. So join and you'll get access to that free webinar that was done by a couple of really experienced small-time developers over in Western Australia. So if you want to learn more about that, you can check that webinar recording out. I also want to bring the attention to what we spoke about last week, which was the Pickers, New South Wales. We know the no grounds evictions legislation is trying to be pushed through the government there. So there's a government survey that we're desperate for you to fill out. And we also want you to fill out our independent survey as well to form part of our submission that we're going to share with the government next week, because that is about to shut off and we need to get that submission in early next week. And also in Victoria, we know that the government is also looking to increase some of the minimum standards in Victoria, which is going to raise the costs of operating your small business in Victoria. We think the timing's really bad, so there's also a survey there to fill in. So check them out in the show notes if you can. That's going to be really important. Now, on today's show, we've got a very, very special guest. It's the first time we've actually had one of our staff members join me on the podcast. So we're going to be talking to an investment-savvy mortgage broker, which is Brad Fraser, coming in from our New South Wales location there. So that is going to be lots of fun when we cut across for that particular interview. And before we get into our great chat with Brad, I also want to mention Bryce. I've done my homework, mate. Yes, we are going to do a Mindset Minute theme this week, and here it goes. It builds off the fear story that we talked about last week, and this is a great quote from an unbelievable individual, and it goes like this. Courage is not the absence of fear, but the triumph over it. The brave man is not he who does not feel afraid, but he who conquers that fear. And that was the great Nelson Mandela. And it just is a nice sort of story when we're sort of talking about anyone who's investing or anyone who's moving through life. You've got to take chances, you've got to take risks, and those things bring you that reward. You don't want to live too comfortably in life, because ultimately that will not necessarily see you live your very, very best life. So there you go. That's the Mindset Minute this week. Hope you approve, Bryce, from somewhere in Italy. Hopefully you're enjoying that. Anyway, let's get into our very, very special guest. And as I mentioned to you earlier, we often get lots of inquiries about what is an investment savvy broker? What separates them from the rest of the pack? And that's exactly why I asked Brad Fraser from our mortgage broking team. So he's one of our elite brokers here at Empower Wealth. And I asked him to join us and to tell us a few stories and give us a couple of case studies. But we also get to know Brad and his journey in terms of money management. So let's cut through to that interview that I did with Brad Fraser earlier. Well, Brad, welcome to the Property Couch. It's so great to have you on board. Obviously, it's a little bit interesting because you're one of our staff here at Empower, but it's just great to be able to share your knowledge as an investment savvy mortgage broker. So let's get to learn a little bit about you. So where's home for you right now?
Yeah, thanks for having me, Ben. I'm looking forward to chatting everything mortgage broking with you. I'm located on the Central Coast in New South Wales, so I'm one of the New South Wales brokers here with Empower Wealth. But yeah, located north of Sydney, an hour and a half, Central Coast location.
Yeah, and you've got a family, a young family. So tell us about your family background.
I do, yes. I've got a beautiful wife and a beautiful daughter. So I've just come out of the sort of mat leave period and into the childcare era. So it's always interesting. But yeah, so she's about 14 months at the moment.
Fantastic. Now, obviously, we want to talk about the mortgage stuff shortly, but like what we do with all of our very special guests that we have on the show, tell us what money was like growing up for you. So did you talk about money around the dinner table?
I wouldn't say it was so much talks around the dinner table, but there was the odd conversation here and there. They weren't very sophisticated conversations, like around sort of, looking into sort of putting your money to use and in investing. It was more sort of basic conversations, more from a scarcity mindset, I guess. So money doesn't grow on trees, or we can't afford that. There was always, hand-me-downs from my older brother, and my mum was just always, I guess, quite tight on money, and just always, on that kind of mindset.
Yeah. Now, obviously, there was something that sort of happened in your family. Like, tell us, how many brothers and sisters?
Yeah, there was so older brother and younger sister. So I'm the middle child.
Yeah.
I had a household where it was a single income. So dad was working single income, and my mum was a stay-at-home mum. So he worked in Sydney, and then my mum obviously was just looking after the kids.
And did you grow up in Sydney, or were you always on the Central Coast?
To be honest, only a couple of years. I was born in Manly, in Northern Beaches. Only a couple of years up there, then we moved to the Central Coast, just more for a lifestyle change. So I had most of my life on the Central Coast.
And who looked after the sort of home economics? Was it mum paying the bills, or was it dad? How did the sort of mechanics of managing money go?
Yeah, because there wasn't very detailed conversations. I wasn't too sure, but I believe it was, my mum doing a lot of that. Obviously, my dad being the primary income earner, he brought in the income. He worked obviously quite hard. Obviously, it's an hour and a half from Central Coast to Sydney, so he would commute 5 days a week just to sort of provide for us. We did, it was like we had a house with a mortgage. We always, we always had things and holidays, so it was a good upbringing. I would say it was sort of like a middle class upbringing. I never went without, so it was good. But yeah, I believe my mum did most of the management side of things, from what I can recall.
And as part of that middle class upbringing, did you notice that you had certain things and not other things, or was there conversations around, well, we can't quite get that brand clothing for you, or or was it everyone wants a bike, but we're just going to have to wait our turn till we hit a certain age before we get a bike? Was any of that sort of noticeable to you at that younger age?
Yeah, so obviously being on the Central Coast, I'm a surfer, and a lot of people who do live on the Central Coast do like to surf. In that kind of culture, there's always the brand names and, the Quicksilvers, Billabongs and all that kind of stuff. So growing up, I always wanted those brands, but, mum was always like, no, we can't afford that. We've got to, get the sort of no brand. So, I guess there was, that kind of side, being a bit, good with your money. I guess with other things like surfboards, we still had them, but we were never always the most expensive ones or anything like that. So it was quite good like that.
Now, was that one of the inspirations for you to get your first part-time job? So I know that you started working pretty young at 14. So tell us about the motivations behind that.
Yeah, so mum kind of always taught us that, if you wanted anything, you'd have to save up for it. So kind of always had that work ethic. And as soon as I was able to work at age 14, I went out and got a job, the local Pizza Hut, or I think it was Pizza Hut back in the day. So yeah, started working, earning money as soon as I can, just to, I guess, save for a little bit more things. Like I said, when you kind of don't have the brand names, you as a kid, you might want that. So, I then save up and put my money towards that. So yeah, there was, I guess, a few little budgets here and there, and my money management started to get a little bit more sophisticated at that stage. But yeah.
But still, that sort of short-term thinking, right? I mean, ultimately, work to save to then potentially buy a board or do that type of thing. Or was there any sort of medium-term planning around? I need to save up for a car, or how did that sort of transition work for you?
Yeah, so I saved up for my own car myself, so I didn't get any finance for that. There was, I guess, at that stage it was really just, when I wanted something, I'd save for it, then buy it, then go back to square one. When I wanted something else, I'd save for it and buy it. So yeah, I was able to obviously get my own car myself. Didn't really ever sort of have help from parents on that regards. There
Yeah,
wasn't any lending from them, or there wasn't any car finance.
financial
So
support.
just always kind of built into me that, if I wanted something, I'd have to just, work hard and save for it.
Fair enough. So really good sort of fundamentals around, if you want something, you've got to work for it, and there's a bit of delayed effort and understanding around the money has some value as opposed to being in a fortunate position where everything was just paid for you. Now, things did take a bit of a turn when you turned 18 years of age, and so you obviously, have a story to tell around that. So what happened when you turned 18?
Yeah, when I was 18, my parents surprisingly got a divorce. It was a bit of a shock for the household because we did have a pretty good upbringing, and it was pretty nice upbringing. So it was a bit of a shock to obviously go through that, and it did sort of change up the house makeup. At that stage, essentially, the way I sort of dealt with it was I sort of ran away from my problems and didn't really speak about it. So that was when I was about 18, 19. So at that stage, I just thought the easiest solution was to move out of home. So I went out and sort of, got a rental and sort of went out on my own at that point in time. So it was a bit of a change up.
Well, I mean, especially when you talk about the fact that it was a little bit of a shock for you, right? I mean, if effectively all the grounding that you had in your life was pretty stable. You weren't sort of struggling at all, but then bang, that rug is pulled from underneath you, and it, mentally and in terms of thinking about things did change a bit for you. Do you want to sort of share a little bit more about what that then meant in terms of your behavior and your attitude to short-term thinking versus long-term thinking?
Yeah, so at that stage, I was at uni. I was doing architecture. So kind of at that stage, I sort of had all these big dreams and aspirations and the likes. And then when that occurred, I guess the direction of where I was going sort of changed. My mindset kind of shifted from, thinking long term to sort of living in the now.
Yeah.
Uni just got a little bit hard for me, so I ended up dropping out after a couple of years, and yeah, just sort of was living, out in a rental, was living week to week, paycheck to paycheck. I got to admit, when you go to uni, you do learn to be quite good with your money because you don't have much of it.
Yep.
So
Yep.
yeah, there was very little coming in and very little going out, and it was really tight, sort of living week to week, whilst also managing rent and bills and everything else like that. But yeah, as soon as uni got a bit tough, I just decided that I just wanted to kind of just work, and it just ended up being a real sort of short term mindset where I was just sort of living for the now, paycheck to paycheck, and I really became like a consumer at that point in time. I think it was like all that conditioning around, money doesn't grow on trees, and not having the nice brands. All of a sudden, I just, kind of started buying the nice brands and getting the nice surfboards and things like that. So my mindset really just shifted to the now, and this was sort of in my early 20s where I was discovering myself as well. So
Yeah.
um, yeah, it was obviously I guess when I reflect on it, was my kind of way of dealing with what happened. But yeah, I was kind of had no direction and sort of a bit lost at that stage.
Did you take on a little bit of debt? Were credit cards a thing for you at that stage as well?
Nah, so I always had conditioning from my parents that,
That's
debt was
great.
bad. So,
Yeah,
like they were always a household where they had a mortgage and they were looking to pay it off. And, I think they might have had the odd car loan here and there. Didn't really talk too much, but they always,
yeah.
said, debt is bad. So never got myself into that sort of bad situation. It was more just, living paycheck to paycheck, and, earning money but not really putting it to work at that stage.
Well, fortunately, though, what you're talking about here, there are people who try to work out, obviously, again, their foundational, understanding of life and love and all those things are being challenged, and so and then you become that consumer and you think of the now, and a lot of people do then go to debt and go on a debt spiral in terms of using credit cards to fill that void of unhappiness or discovery and just learning different things about themselves. So credit to you in terms of staying the path that you still believe that, I was going to have those things, but I was going to get those things based on the money that I had rather as opposed to using the bank's money and getting into some serious debt.
And that was the time of when Instagram was kind of coming out and socials were coming out. So this is going back, almost 15,
Yeah.
14 years ago.
So
So
social envy was just starting to be a thing, right? In terms
yeah,
of, look
yeah.
at
So
me. Yeah.
that definitely fed into it, and sort of putting up your sort of weekend or putting up your new surfboard on Instagram was a thing back then.
Yeah. So now, obviously, then, so what broke that sort of method and that sort of mindset? Tell us about when things started to get serious for you and your life, and you started to think, well, actually, if I'm going to aspire to be something and have a meaningful life and live a fruitful life. What did you start to think about, and what did you start to change?
Yeah, so it all started. I was probably about 24 years of age, and I met a girl. So that's my wife now. Yeah, and when I met her, she was quite a hard worker. She, had a degree. She was working two jobs at the time, and it was quite an inspiration to see, her sort of, in that position. And it kind of, made me reflect, hey, what am I doing with my life? And I should start thinking a little bit longer term. We started getting a bit more serious. So we started going on, holidays, so big trips. So
Yeah.
we started to then, cut back the spending, and the savings were more around experiences. So, we'd save up for a Europe trip, or we saved up to go to America. So just, putting more money away and building up bigger amounts to then go on holidays. But yeah, again, there was no sort of investing at that stage, and there was no
Yeah.
sort of sophisticated money management. It was more around obviously the experiences that I was going to have. With her, obviously, it started to get a lot more serious. So then I did start to think a little bit longer term. How am I going to provide for her? How am I going to provide for my future children and the like? So I guess it was a big pivotal moment when I started to have those thoughts.
Yeah, and was there a lot of dialogue around that, like in terms of that life planning that you do? I know with Jane and I, when we worked out that we were going to be get married at some point, we started to think and talk about properties and kids and all of those type of things. Was there a lot of open dialogue about that, or was this sort of something that you were keeping to yourself in terms of how that was going to play out?
Yeah, we both obviously shared the same goals of obviously having a property. And I think that was just, I guess, conditioned into us from our upbringing. Our parents both had properties. Her parents had properties as well. So, owning our own home was a thing that we wanted. So yeah, I did start to go down that path. I think, there was a lot of thoughts individually myself, trying to improve myself and sort of work out how money works. But we did have conversations that we did want to, have our own place and, set ourselves up for sure.
Goals are a powerful thing, especially when they are united. So that's a good news story. All right, so let's start thinking about, okay, you finished a bit of this travel. Now it's the big rock in the jar is the family home and getting serious about your future partner. What does the career options look like for you in terms of what were you thinking about? That sort of led you into becoming a mortgage broker.
Yeah, so at that stage, I was working in retail, and The pivotal moment was I came back from one of the big trips that we had and came back with nothing. I sold my car prior to going there. I think it was the original car I bought when I was a teenager, and
Yeah.
um, came back, had no car, no money, and ended up back at mum's place, and was kind of like, oh, I need to do something, and my first thought was, how does money work? How do you make money, and how do I put it to use? So that did lead me down a journey of trying to discover how money works, and then that led me to going back to university and studying finance, so a Bachelor of Commerce, major in finance, which did start to lead me down the path of brokerage. So after I finished my degree, it was, I guess, exploration of the industry. So trying to work out where I'd fit and what I was interested in. And that's when I started to obviously look into brokerage after my uni degree.
Okay, so now I'm going to come back to the whole idea of what you love about broking, but let's start to unpack a bit of a story about what the investment savvy broker looks like. I mean, you're one of our highest performing brokers in our team. We're absolutely thrilled that you're part of our team. But what do you think it is? I mean, we talk about this. I know it was Bryce who coined the phrase investment savvy broker, and it seems to have stuck on our pod in terms of the way in which we look at our own brokerage team. So tell me a little bit about what you think it is to be an investment savvy broker. So what are the certain things that you look for, and how did you learn that transition from what might be a standard broker to an investment savvy one?
Yeah, so an investment savvy broker, I guess it comes down to the level of detail that broker might have with the client in their interactions. But I guess I can talk from experience, because when I did go out of university, the first job when you study finance is you go into the banks. I went down that path. Started to discover that banks were quite limited with the solutions that they could provide. So then sort of led me to other avenues. I always had a keen interest in property, so I started to look into property related items or jobs, sorry, and that sort of led me into a brokerage role. So I started with a large fintech company that was kind of leading the way of online brokerage at the time, and really got thrown into the deep end with I guess learning my craft. So did 2 years with them, and with them they are, I guess, a standard sort of brokerage business. And when I mean standard brokerage, it means the way that the business is set up and structured. It's more designed around sort of volume, more heads, more clients in is better for their business and bottom line. Kind of similar to the way banks work is, they're looking to bring in more people, and I guess it's that whole quantity versus quality kind of thing. When I did my 2 years with them, I sort of learned my craft and the likes, and I did feel that the way that the business was set up was a bit limiting to what I wanted to provide for my clients. I did obviously through my degree did a lot of financial planning and the likes, and that analytical side of things, the way that you can review a client situation and then try to come up with a solution really resonated with me. So an investment savvy broker is really that type of broker who is going to look at things a little bit more holistic for you.
I tend to agree, Brad. I mean, I know, my experience also, I came through a franchise group when I first started off as a broker many, many years ago. And I relate strongly to what you're saying. And even though, technically you come into the industry about 10 or 15 years after I basically came into the industry. And what I noticed about the training and the development that you got as a standard mortgage broker is it was very much product-led discussions and features of the products. Now, I can understand back in the day, ultimately, you don't want to be giving financial advice, and that's not our realm. I mean, at the end of the day, we're about to give credit advice and borrowing advice around a particular customer's circumstances. Now, we know that the regulation has obviously matured a lot since when I was there, but that was my really interesting takeaway. Exactly what you just said before was, and I mean, as a franchise, they're hoping you do the volume, but they're not putting the pressure on you because you're not a staff member or alike. But what I found by that was that that the conversations I wanted to have were more holistic. I wanted to know about big rocks in the jar. I wanted to know about future plans and all of the goal setting and all of that, because I thought that should inform the type of lending that I'm going to do for you. And I think, you've just highlighted to me in terms of and reinforced that message, which is that's exactly what seems to happen in traditional brokerages, that it feels a little bit more transactional and product led in terms of, okay, well, here are the best lenders and these are the different options, but it doesn't feel like it's a part of that sort of broader conversation.
Yeah, you can really tell in the initial meetings with a broker, I guess, the direction that they're taking you down and the questions they're asking you. If they're spending a lot of time around, what are your goals, and is this property your forever home, or are you looking to move? What are your employment prospects into the future? So it's not just looking at your financial position now, but kind of trying to unpack a little bit more around what is the next move and what does it look like over the next, 2, 3, 4, 5 years, because that can then formulate, which type of product we'll select for you. And that's the key difference to an investment savvy broker is, we've worked through developing, we've worked through a longer term approach on the product selection rather than just going straight to the product selection for here and now.
Yeah, and a lot of people think that, from an investment savvy broker point of view, you're only potentially dealing with investors and, you're only potentially dealing with investment property purchases. But that's so far from the truth. Like ultimately what we're sort of talking about is, the broad reaching broker, the more advanced and superior type broker, maybe senior broker, you might call it, because there are obviously lots of examples where we help first home buyers, and there's lots of examples where we're helping people get the big rock in the jar, which is their principal home, whether that's an upgrader or a downgrader. We've just probably worked off Bryce's coined phrase of investment savvy. It just means you're at that next level. So let's talk about a couple of examples there. So let's start firstly with a first home buyer example. What do you think really separates a broker who's trying to help someone get into their first home and not just thinking about the lending solution as part of that?
Yeah, so I love that because obviously, we're not just working in the space of investment properties. First home buyers, we do work a lot in that space as well. And I do love working with first home buyers because, especially if they are looking to get into investing as well, there's lots of ways you can approach it. And, there's lots of incentives out there as well that can help you get into the market. But I do have an example, we'll call them Jane and John Smith. And with this example, they were referred on to me by one of my other clients because they spoke with another broker who I'd assume would be more of a transactional broker. And they were kind of a little bit dissatisfied with the result and the conversation. So a bit of background with them, they're first home buyers. They migrated to Australia from South Africa, and they're Australian citizens, so received their citizenship, living in Canberra, and they're sort of in their 40s. They have no kids and had no intentions to have children as well. They didn't have any family support as well, obviously migrating from South Africa, so wanted to start afresh in Australia and sort of get into the property market. Had strong savings, built up about 100K. And their primary goal was really just to purchase their forever home. So just to purchase one home. And they didn't really have any intentions to purchase an investment property at that point in time. So this is a key example of someone who might, be coming to an investment savvy broker and not need an investment property. It's really just looking at one property. Came to me. I reviewed their situation, so their financial information, and I guess a bit of summary of their position was, they worked for government, being in Canberra, and also she was working at a university, both full-time, pay-as-you-go employees. The combined income was about 200K, so 100K each. They did have a car loan and a credit card, but the credit card was always paid back on time, so not really outstanding.
Yep.
Like I said, they had saved 100,000 and they had noted that they want to use about 70 of it, and they were quite conservative as well. So through my conversations, I could tell that they were, a little bit of a different mindset to a lot of people who might have grown up in Australia, maybe a bit of a different background growing up in South Africa, the way that property works and debt works.
Yeah,
So
so a little bit of fear in there. Yeah, fear and
yeah,
apprehension. Yep.
yep. So they were quite conservative around, taking on the debt, and also, didn't want to chuck all their money into that property as well. So
Yep.
they wanted to have about 30K buffer as well. They had strong credit reports, so good conduct, and you could just tell that they were good money managers. So really came to Australia, got good employment, and really built up a nice amount of savings. They were quite specific with their location and their property type, because this was going to be the forever
Yeah.
home. So
Yeah, big rock in the jar. Yep.
yeah, that was a key thing to the strategy, was they didn't want to budge on the price point at all. And the reason they came to me was because the price point was 750, and they didn't get the price point with that other broker, and they just couldn't get there. So obviously it's 750 with 100,000 savings. It's a smaller than 20% deposit. So, with a smaller than 20% deposit, we're playing in the space of lenders' mortgage insurance.
Yep.
Or because they are first home buyers, there are government incentives like low deposit schemes and the likes that can help with reducing your lender's mortgage insurance.
Yep.
But they did obviously have to go in with a smaller deposit. When you are going in with a smaller deposit, your lender options, are a little bit more limited as well, especially if, borrowing capacity, if we're going to the maximum borrowing capacity as well. So when I did unpack their situation and run the numbers, I did agree on initial face value with that other broker that, they couldn't reach that price point of 750. So during the first conversations, there was a bit of, I guess, education around, why that was.
Mm-hmm.
At this stage, so it was a recent one, this scenario, and at this stage, rates had obviously increased.
Yeah, the buffer rates are definitely pushing down borrowing capacity, aren't they, at the moment? Yep.
Yep. So that definitely obviously made things harder with where rates are at, and also that 3% buffer that they're still putting on top of any sort of mortgage assessment. They weren't fully aware of that, and they were sort of running online calculators and sort of going, hey, I can afford these repayments at this sort of loan that I'm
Yeah, you
needing.
can understand their disappointment and frustration, can't you? Because it's like, wait a minute, household income, couple of 100,000, 200,000. We've got good savings, got good discipline, and why aren't we allowed to borrow money that at a level that will get us into our dream home? It
Exactly.
can be really frustrating, right?
They were comparing to their rent, going, look, it's not much different to the rent.
Yes.
They needed 700,000 loan. They looked at the repayments based on rates online, and they were going, look, we can afford this. I don't know why we can't borrow it.
Yep.
So there was obviously some conversations and some education around why that was. But then I started to, I guess, look at the problem. So it was no budging on price. So it was established that they didn't want to budge on price,
Yep.
and they were quite set on that location that they wanted to purchase. Being a forever home, obviously that makes sense. You don't want to sort of compromise on that forever home, because it might end up costing you more if you purchase, pay stamp duty and all the other cost of getting in, and then you then decide after 5 years that it's not suited for you and want to move away and the likes. It could cost you more. They did obviously as well take quite some time to build up this deposit and get to this position. So they were quite eager to go as well. So, the other option is, do we, wait till they build up some more deposit to get to that position? That was also explored. But they weren't quite keen on that. So I went back to the drawing boards and sort of looked at what we call levers. So you guys obviously talk about it. Levers, income, expenses, liabilities, or time is the other thing. So like I said, with time, they wanted to go now. So I had to start looking at other things like income, expenses, and liabilities.
Yep.
With incomes, they were in roles which was just standard base salaries, and there was no real sort of way to change that in the short term. With expenses, they were quite good with their expenses, so there wasn't really much I could do there either. But with their borrowing, obviously they had a credit card and a car loan that we could work with. So the solution I came up with was, so you probably obviously, I'm sure the listeners know that with credit cards, they do affect how much you can borrow. Even though you might not be owing anything on that credit card, they always look at that spending limit. They assume that you've gone out and you've maxed out that credit card and that you've got a repayment on that credit card. And then they're putting that into your borrowing capacity servicing calculator and assuming a repayment on that credit card. So straight away, I let them know that that's a solution to get a little bit more borrowing. So they were happy with closing that credit card off. So we did that. That got them about 50,000 additional borrowing capacity there. The other thing I looked at too was their car loan. So they had a car loan with ING, and that car loan had repayments of about 780 per month, and it had a 3-year loan term left on it. So I looked at that and sort of went, hey, there's probably something we could do with that. Could we stretch that loan term a little bit further out and reduce that repayment so that we can unlock a little bit more borrowing capacity? So we had conversations. They went off. I don't do car financing, so I didn't do the car finance for them. They went back to that lender, ING, and they went, hey, can we extend the loan term to 5 years, and can we, work on a different repayment structure? They were able to half that repayment and extend it over to a 5-year loan term. Now, obviously, at face value, people might be thinking, well, that's going to cost you more.
It's going to cost a little bit more.
Yeah, it's going to cost you more. So, obviously, that was front of mind. We don't want them to extend that loan term out on a car loan, which is a depreciating asset, and it's going to cost them more. So I did understand that. So what we then did was, well, let's run the numbers and have a look at this. So if we can unlock a little bit more borrowing capacity by reducing the repayment on the car loan, that enables them to borrow and achieve the target price point. So we're able to get them onto the borrowing they needed, and that 750 price point. But then what we then looked at is, well, the banks are putting a 3% buffer on top of the mortgage repayments. So there is a bit of a buffer in your monthly cash flows that we can work with. So all I then did was go, well, let's put that, original 780 repayment per month. Let's make that your actual repayment that you're going to make on the car loan, so that you pay that car loan back within that 3 years. That was the original loan term. Brilliant. And then once you have that paid off, that's going to free up more capacity to start putting towards the mortgage.
Brilliant. Can we stop there for a sec? Because I want to just make sure the community understood what we've just done. So you'd be thinking, well, that doesn't sound like a great idea in terms of extending the car loan out. Now, remembering, because it's a 3% buffer rate, it's not the true rate that the borrower is actually paying. So what we're seeing here, by Brad being very smart, saying you're not going to pay a cent extra on additional repayments because we're going to pay extra on that car loan, but by making the repayment lower, it meant we were able to stretch the borrowing capacity, which means we're going to be able to get into our principal home that's also going to hopefully appreciate in value over time. So there's no net loss here, but it's critical thinking in terms of how we then organize the finances. So this is much more than just now the mortgage that we're talking about. So this is a great example of where an investment savvy broker is getting to work in unpacking all of the ways and the solutions to allow the borrower to achieve their goal. That's why they've come to see Brad, to achieve that particular goal. So keep going, mate. This is a good story.
Yeah, and keep in mind the banks are looking at the minimum repayment on the car loan. So Correct. When they're looking at the assessment, they're looking at the minimum repayment.
That's right.
But once you've secured the mortgage loan and you're in the house, obviously how you manage your debt is really up to you, not how the banks have seen it in the initial term. So all they needed to do was just make that additional repayment, double the repayment per month, then they're back on track with paying that car loan on. If they have a little bit extra, I encourage to get rid of that car loan sooner rather than later, because obviously that will help them in the long term.
Higher interest debt, that's right,
Correct, obviously it was, it was a 3% higher rate than the mortgage rates at the time, so obviously the most expensive. So they were, like I said, one house forever. Didn't want to sort of, at this stage invest. That might change as they become, property owners and the likes. So the key thing was then, get them into the location that they wanted. We got them onto the market, pre-approved. We got the loan amount that they needed, and then they obviously went out and executed and ended up finding their forever home. So got the property that they were looking for in the location that they were looking for, didn't have to compromise there. And then I've just given them some pointers around, how they can manage their debts ongoing to make sure that they pay that down. As mentioned at the start, they were conservative. Also, too, they just wanted this house and wanted to pay it off. A bit of that sort of older school sort of mentality there. So, gave them some pointers around, making more frequent repayments and making additional repayments above the minimum, just so they could knock some years off that and save quite a lot of interest over the life of the loan as well.
It's a really solid point around an investment savvy broker is an educator and they guide. And so part of the problem solving and solution finding that an investment savvy broker is to unpack the full story, see where there's areas where you can make some of those tweaks and just inform the customer in terms of what their choices are. Now, congratulations to this couple who obviously then said, well, they went away and did their own independent assessment of their car loan, then decided, well, okay, I can see the value in doing that, but also flagging with them that, that we don't actually have to change the repayments, even though what we have to declare as the minimum contribution allowed us to get a maximum borrowing power that facilitated them buying in the location that they wanted to buy in. So
it's important to also note as well that I didn't go to any sort of third tier lenders or any sort of, other lenders. So I was able, because their priority was to pay off the mortgage and to keep the interest rate quite competitive. So I was looking down the space of that first home buyers incentive. So no lender's mortgage insurance, which is essentially you can go in with a 5% deposit and then the government will guarantee you with selected lenders. Therefore, you don't have to pay lenders' mortgage insurance. The other benefit to that was they did get a more competitive rate. So we weren't dealing with, very high rates going into the transaction. So a lot easier for them to manage as well.
And I think that's a really nice point. If I can sort of add to what you're explaining there is that traditionally, if you're, in some cases, if you're looking to get higher borrowings, there's usually a higher risk from that lender and they accommodate that risk through a greater margin by charging a higher interest rate. Now, what Brad's just told us is that we didn't have to compromise or do any trade-offs in that respect. But yeah, this journey that you've taken the customer on from being sort of apprehensive, low risk, low understanding to moving the dial on their education and then taking them on that journey delivers a really happy customer and they've bought their property in the location that they wanted to buy it in. Any updates on their story at the moment? Is there,
Well, they settled. It was a transaction at the start of this year. So we do annual reviews. So there'll be a check-in in 12 months and sort of see how they're traveling with, the debts. And it'll be interesting to see. It'll be nice to see them sort of knocking down some of those debts and, getting close to, having it all paid off.
Beautiful. All right. So that's a great example of a first home buyer. And this is what this session's about. It's about going deeper on some of these types of examples. So I want to go to our second case study example. And this is purchasing an investment property. So let's talk to this particular story and we can see what, unpack this story for us, Brad, in terms of how you use your problem solving skills and your solution finding skills to get a result for this couple or this customer, I should say.
Yeah, so this one was quite a interesting one. So kind of a little bit of out of the norm sort of situation. I guess we are quite privileged that a lot of people who do listen to the podcast are quite good with their money and sort of when they do come to us have sort of built up quite a nice position. But, I'm not going to take anything away from this guy. He's obviously quite a hard worker. But when he first came to me, it was post-COVID when in 2021 where the property market obviously started to run and we had such, large growth. And he obviously started listening to the podcast and he had a primary place of residence at this point in time and then wanted to be a property investor and wanted to put his money to work. So he reached out to us and said, I want to purchase an investment property. I want to, start building wealth through property and the likes. At that point in time, as mentioned, he had his primary place of residence. He was single. He had no kids and he was aged around 30 years old. So this was a few years back. His primary place of residence was around 450 mark at that point in time, and he had a loan of about 210. So quite a strong position when it comes to equity. So he had about 100,000 that was released, and he actually spoke to a previous broker to get that equity release. So he might have got mistaken with that whole investment savvy mortgage broker. He probably should have came to me for the equity release, because the way it was, because he came to me obviously to execute on the investment property. But what I realized when I started looking at this situation, that equity release wasn't quite structured very well. One, he had put the equity release in the redraw facility, and then two, it was on principal and interest repayments. So, and also two, he wasn't really educated around how how that works, and he was a little bit confused on how that was structured and set up. So there was a few sessions with around sort of guiding him around how it was supposed to be set up and how that was to work. They obviously did it right in keeping it in a separate loan split so that we could keep it separated, but there was just a few little things that weren't set up correctly.
Yep.
So a little bit more of a background on him. So he wanted to purchase around sort of the 400, 500 mark. He had plans to obviously have a family in the future, once he met the right person, but at that stage was single. He was a correctional facility officer, so worked in a prison, and quite a hard worker. You could tell through his salary that he did a lot of overtime and the like. So his salary was based on a base salary, but then quite a bit of overtime as well, and shift penalties and allowances and the likes. So with his position, I started to then review his financial position and started to see some things that wouldn't put him in a position that I would say was ready to purchase an investment property. So his savings wasn't quite strong at that point in time.
Yep.
And when I looked at his credit report, there was a couple of missed repayments from about six or so months ago. And he had a few credit cards there that just weren't really managed very well. So I sort of asked him as to the reasons why that was occurring, and he said, look, his dog had needed to get surgery, and he had some family issues that he had to get through, and just was a little bit lost and misguided there with his money management. For me, I sort of, made the decision that it just wasn't right for him to be purchasing investment property, even though the market was sort of going and he was looking at the news and, everything was telling him to purchase an investment property. His personal economy just didn't allow him to purchase at that point in time. I just looked at the overall position, just when it would be a bit too risky for him to take on more debt at this position. So what we did was we had a few more meetings and kind of just guided him through what he needs to do. So we restructured that equity release correctly so that it was sitting there and preserving it for when he's ready. I gave him some pointers around closing off his credit card. He started to implement the Money Smart system as well. So he was introduced to that through the podcast and, was starting to implement it when he met up with me, but I just sort of helped him and guided him into sort of fully putting that into place. And I said to him, come back to me in 6 months and we'll review it. I need you to have a bit more savings, and I need you to make sure you're meeting all your mortgage repayments. Sorry, the missed payments weren't on the mortgage, it was on the credit card. So I wanted him to fully clear those credit cards, and just said, look, just build up some savings and make sure you're meeting all your repayments and clean up your credit report, and then we can revisit it in 6 months. Now,
and building those habits and behaviours and that discipline around money management, and obviously Money Smart's rules-based system, really easy to do on the More platform. Obviously, that's boded well. So what's the outcome? What's
that
the big reveal?
ABCD of property investment, right? It's like you start with the C, right, which is the cash flow management before you do the borrowing, right? So he's come to me and he didn't quite have the cash flow management right, and he was obviously looking to get the borrowing to purchase the investment property. So we had to go back to step one, which was the cash flow management. Now, at that point in time, telling someone, no, we can't purchase, he could have went off and went, stuff you, Brad, I'm going to go find my solution somewhere
And there could
else.
have been a broker out there who would have forced the deal through and put them into all manner of strife in terms of, there you go. Yep.
Correct. So, quite honoured and that he did sort of listen. And 6 months later, he came back to me and I reviewed his situation, and it was in a lot better position. Had built up savings. His credit report was a lot cleaner. Got rid of all the credit cards and just was in a lot better position at this stage. Savings was the key. He built up enough savings to be able to sort of manage more debt with a bit of a buffer there and lower the overall risks. So we looked at his situation at this point in time. This is where rates started to go up. Yeah. So it was kind of post that property cycle, and then obviously rates started to increase.
Welcome inflation into this, and then off rates go. Yes.
Yep. So had a few rate increases at this stage. So then, obviously, with rate increases, borrowing capacity started to dwindle as well. So the challenge at this point in time was his borrowing capacity to be able to execute on that purchase. Now, because he was on a single income, obviously price point was limited. So estimated that his price range was around that 450 to 480 price range, which was on the smaller end. We did have to start working with alternate lenders at that point in time, just to ensure that he could achieve a purchase that was worthwhile. The other thing I sort of did was encouraged him to use a buyer's agent, because if he was on a single income and he was going to purchase an investment property and maybe only be able to purchase a few more over his lifetime, we wanted to get that property right. So he did work with Krista, as one of the buyer's agents here in Empower Wealth, and they ended up going into the Adelaide market with that sort of budget at the point in time. So set him up with the third tier lender, got him onto the market, got his lending all set up. And at that point in time, Adelaide was still running. And that price point, because rates were rising and people's budgets were getting tighter, that price point was very, very hard to find the right property. And it was quite competitive. So Krista had her work cut out at that point in time. But she's great at what she does, and she was able to find the right property for him. So got him the property, we got it all settled, got it all sorted out. Now, as you mentioned before, when you do work with these alternate lenders, they do come with a higher rate. You do get extra borrowing to be able to get to a nice price point, but they do come with a slightly higher rate.
That's the trade-off. Yep.
That is the trade-off, yeah. So my view is there's always a good lender there's a lender that you will use when you're looking to purchase a property, and that lender might be different to when you're in the property and we're looking at reducing rates or looking to refinance. So the strategy I had in mind for this client was, obviously we'll execute with this alternate lender. There might be a trade-off with a slightly higher rate, but we'll look to obviously improve that over time. So fast forward a couple of years, it was about a year and a half later, and caught up with him with an annual review and just sort of said, how are things going? And he's going, look, I'm managing. Obviously with rates increasing, it's gotten a little bit tighter, but I'm managing to get through. At that point in time, he did say that he did couple up as well. So he did have a little bit of help with his own mortgage. So that kind of helped him out a little bit as well. So she was living with him and helping him with that mortgage. I've reviewed his situation and then was able to look at, like I said, other lenders that are more suitable to refinance at that point in time. So then I took him away from that alternate lender, which does have a little bit more risks, especially when rates are moving on, at that point in time, they'll move in every month. So does bear a bit of risk on your cash flows when you've got a third tier lender that might sort of change the rates at a slightly higher amount than the RBA.
For sure. Yeah, so, and every dollar counts, right, at that stage. Yeah,
exactly. And he was a single income, right? And a sort of average income. So, obviously being with that type of lender was a high risk for him. So the strategy was to then move him away and take him to sort of the bigger institutions that have more competitive interest rates. So I was able to then bring all his mortgages back to a major lender, and I believe I shaved off sort of a 0.5% on his rates, and it ended up being about $132 per month difference in repayments at the time. So sort of helped him, a little bit through that situation when rates were rising as well. So the whole strategy was, not quite right now. Cool off a little bit. Let's come back, work on the cash flow. Then he came back. Then we executed on the purchase. We made sure we got the property right, and then we then reviewed the mortgage. And now we're just sort of, improving things where we can.
Yeah, it's a really important reminder to sort of say the lender that you again trade with in the first instance isn't necessarily going to be the lender that you're going to play along with for years and years to come. Part of a role of a great broker, an investment savvy broker, is they're building a relationship with you. They want to make sure that they're checking in and almost being like your personal banker. And I think that's a really important message in the two examples that you share with us so far. We've got more that we could talk about. There's obviously hundreds of other examples of this type of thing, but those two simple examples just basically says that where there's a will, there's a way. But again, we want to prove that you've got to be diligent and respectful of is the family or the person in a financial position to actually execute on that. I mean, the will is strong, that's great, but we want to also make sure that the habits and behaviours are in play, and that's exactly what you've done there, Brad. And you've come back and tidied that up, and I'm assuming the property's also gone up in value, so that's ticking along nicely.
Yeah, after the 12 months, it obviously went up in value, which obviously helped with obviously when you do refinance, you do have better loan to value ratios and the likes. But it was a story of, sort of building a relationship with the client and sort of seeing him put things to action and improve his situation gave me confidence to sort of, increase the risk with the lending structure to execute and then sort of bring the risks down once he was in that property. So, yeah.
Job well done. So, mate, that's, they are two households that you've made some meaningful contribution in. So what do you love most about being a broker?
I guess I do feel quite privileged to be able to get insights into each, of my clients' households. And, obviously they do share quite a lot around their financial information and the like. So I do enjoy, when they do come to you with a problem and then obviously coming up with a solution and working through ways that we can, come up with strategies to help them build either wealth or to help them get into their property that they're looking to purchase.
Yeah, I remember back in my day when I was sort of in the first few years of broking, and I had an older lady come to me, separated in a relationship, and she had 3 kids, and we helped her educate her buying her own home without her partner. And then we also added an extension on the back. So she came back for an extension to sort of put this, nice big extension on the back of the home that we found and bought for her. And I got invited to her 50th birthday party, and it was just really magical to be there and just take a moment to sort of say, we're helping create those memories. And that was the moment that I thought broking has a really powerful sort of meaningful way in which we can serve others. And the problems that we were solving for her was to create those memories and provide a safe and secure home in a great area that she was looking to buy. And so, that they are the memories that stick with me from the problem solving and the broking work that we get to do. So it really is a wonderful privilege, isn't it, in terms of being able to be led into people's lives and they're entrusting you, to sort of guide them on the right path.
Yeah, and we're not getting them alone. We're getting them a property or helping them build wealth. So,
Yeah.
there's more to that than just the finance side and the numbers. It's what that creates. And yeah, you're right. When you do see those changes, or when they do buy that dream home or that forever home, and see how excited they are, it does humble you.
It does. And, as you know, the business has been going for over 20 plus years. And so from that point of view, it's really just humbling to sort of know the sort of meaningful impact that you're having on these people. And so, yeah, it's just a great feeling. So, mate, thank you very much for coming on the pod. It's the first time we've ever had one of our staff actually join us for a professional session as a subject matter expert, and in your case, as an investment savvy broker. So we really appreciate that, mate. Now, Brad, before you go, obviously I wasn't going to let you go, and I didn't want to have to do the life hack. I don't want to have to do Bryce works for him while he's away. So, mate, have you got a life hack for us?
Yeah, I don't know whether Bryce has said this one before, because it would be quite up his alley. I know he always has iPhone hacks.
Yes, he very much likes his hacks on the iPhone.
Or Android hacks, depending on which user you are. But mine is, involving the phone. It's something that I've done recently. It's essentially turning your phone into a actual phone and getting rid of all distractions. So obviously with the phones we've got these days, they've got apps which all have notifications to try to draw you in and get your attention. So what I've done is gone into my phone, to the settings page, and going to the notification center, turn off all notifications apart from the phone and the message app, so that you can still receive text messages and phone calls. But essentially all your socials, all your other apps, your productive apps and everything like that who are trying to draw you in, you're not getting those notifications throughout the day. And then, if you are one that wants to keep up to date with your socials and the likes, you just have a period in the afternoon where you just, open up your phone and click onto the apps and everything will be there. You're not going to miss out just because it hasn't notified you. So that's my little hack, is just turning everything off and keeping it like a phone.
I absolutely love it. Like the old Nokia 3315s, right? In terms of that's all it did was text and actually, call like a phone. So I think it's a great productivity hack. So thanks very much for sharing, Brad.
Thank you.
And thanks for joining us overall. It has been a wonderful experience. Those two case studies that you unpacked are just a sample of some of the great work and the challenges and problems that you overcome as part of the work you do here for us. And so we're obviously forever grateful for all of that great service that you provide for our value clients. So thanks very much for joining us, mate.
Yeah, thanks for having me, Ben.
Okay, so let's now move on to the What's Making Property News story. And one of the biggest stories that broke earlier this week was the New South Wales government also looking to freeze the indexation on the land tax threshold. So that means that the 2024 figure, which is at $1,075,000, is actually going to be capped. So that means as land values continue to grow, not the improvements on the land, but the land value, it does mean that the New South Wales government is going to increase their tax take on property owners who own investment properties or also who own second dwellings, so not their principal place of residence in New South Wales. So they did promise that they would never increase new taxes in New South Wales, but we all know we can't rely on our governments. They'll always change their mind, especially when they're trying to raise more revenue for their spending. So that was obviously the big story, and we'll continue to keep reporting as we learn more about the potential consequences. But it certainly, again, is another potential detractor for investors looking to invest in the New South Wales market. Now, the other thing I also just wanted to highlight in What's Making Property News, and the RBA and economic update that I did with Evan Lucas earlier this week, there was a little confusion with one of the final tables that we spoke about, which was the analysis cost. We did a snapshot. And so effectively what I was using there was dwelling values versus house values. And a lot of people didn't understand that difference. And I had a slightly different yield calculation in there. So I just want to set the record straight. If you want to find out all that correct information, I've now posted those on my socials. So if you want to find me on X, formerly Twitter, it's Ben Kingsley AU. So you'll find me there and you'll see that table posted there. And also, if you're looking to find me on LinkedIn, you'll also see that table in terms of what's available there. The message is still the same. There's still definitely a certain gap in terms of how much the Melbourne market could move in terms of rental based on the affordability or the median weekly earnings as part of that particular story. So I just wanted to highlight that if you wanted to get that correct information. They're out on my socials at the moment. And that sort of wraps up another show, my first show ever without Bryce at the helm as my co-host. We have the 500th episode next week. It's going to be epic. We have a world-renowned guest on the show coming in from the States. Bryce and I did do that pre-recording before he went on his European expedition with his family. So check that out next week. It's going to be a huge show. And we've also got a couple of really big note guests that Bryce has also done prior to leaving. So you want to also not miss out on 501 and also 502 as well. So until next week, always remember, knowledge is empowering, but only if you act on it. Bye for now.